Welcome to the Times of Industry Show. I am always thrilled to speak with today's guest. He's a returning guest, Mr. Charles Hugh Smith of twominds.com. He's an independent thinker, a great writer. His books are on Amazon, on his website of twominds.com. And he's here to discuss obviously the coronavirus, supply chains, markets, bonds, Trump's re-election, precious metals. And I think this is one of the best interviews for everyone to listen to right now, because this is very data driven and not based on any emotion or bias. This is all facts, and I love the way that he analyzes markets. Charles, thank you for joining us.
My pleasure, as always.
I want to ask you first, let's start with coronavirus. Why can't the origin be traced? That's question A. Because I've heard several stories about this, and we've seen denials from China that it started in their fish market, etc., in the Hubei district. B, why is it so disruptive to the global supply chains? Are they that fragile, or is this just not properly handled? And C, do you believe that quarantining like 400 million people in China was the way to go?
Great questions. In terms of the origin, I of course have to start by stipulating that I'm not an expert in genetics, and so I just have a layman's understanding and interest in it, like most of us. I believe that viruses, as a general rule, and coronaviruses are also like this. They mutate very rapidly, right? That's partly why they're so dangerous, is they mutate very easily. They're unstable, and so the Chinese authorities and also scientists in the West have sequenced the genome of this coronavirus. And in a number of timeframes, right? The earliest samples are, of course, in China, and then the later samples are present in the West. And so they're trying to compare, the rate of mutation, like the mutation drift, and they're trying to figure out how much of it is related to the SARS virus. And apparently, from what I've read, it's almost an 80% match. So. And other people have gone astray by looking at little snippets of the genome, and they're saying, "Wow, this looks like HIV virus." But viruses, like all of life, they use bits and pieces that are very similar to other viruses, and so it turns out I think it's fairly tricky to identify exactly where this came from, and so that's an ongoing thing. In terms of the why it's so dangerous, or why to the supply chain, yes, the supply chains have been optimized for perfection, and if you know people who are in the corporate, global corporate supply chain, they'll explain that there's like 4 layers deep here. The supply chain isn't just the finished product. Of course, there's all the components, which could be circuit boards, and which have components within the circuit board. And so it's like you go down each layer, there can be a disruption that then disrupts the supply chain, 4 layers deep, 3 layers deep, 2 layers deep to the final product. And because the competition, at least within China and the global supply chain, has been quite intense, then there's been this huge push to get rid of redundancy, second sources, and everything, and to limit the cost of keeping inventory, right? So-called just-in-time delivery and inventory. So all of those management methods to optimize profits by reducing costs, they come at a cost which is now only becoming visible, which is you get rid of redundancy, you get rid of inventory, you get rid of alternative sources for critical elements of your supply chain. Well, then you realize now the whole thing's disrupted because you got rid of all those costs, but those costs had benefits. And so now there's this huge scramble, right? And of course, the most dangerous part of a supply chain is if there's only one source, right? One unique source for various components, or that source is overwhelmed, right? That there were 5 sources, 4 are closed, there's only one left. They're running 24/7. They can only supply 20% of the component globally. So those are the kinds of snafus and difficulties that are arising. And on top of that, as many of us have been predicting for quite a while because of the trade war, the global supply chain is trying to get out of being dependent on Chinese supply sources. And so this is now accelerating that desire for global corporations to find some other source outside China. In terms of your last question, the quarantine, a lot of my friends who don't follow it quite as closely as I do are surprised by this because they look at the so-called official deaths in China, which are 22,500 or something rather small, and they wonder, well, why did the Chinese react so dramatically here, like quarantining 400 million people, shutting down most of their economy? Well, I think we can kind of infer, just as a matter of logic, that the Chinese authorities made these decisions based on facts that were known to them but are not known to the rest of the world. In other words, this was much more lethal than they're letting on. It's much more disruptive. And so they felt, it seemed to me, we can conclude they felt that this massive all-out quarantine to save their industrial coastal cities was their only option.
Yeah, it's kind of hard to judge with the partial information that we have. And obviously, now that this is in 50-some countries, many of them first world will have much more information that will be properly disclosed. Because obviously, when you're running a country with 1.4, 1.5 billion people, you don't want to start a panic if you don't have to. And you want to drip information to keep people safe and healthy, but you don't want to do anything that creates any sort of fear mongering, in my opinion. Why did gold and silver rally hard, then sell off hard into the weekend? I have my own opinion on it, but then today, as we're doing this interview, the gold's up like $50. It's back to 1650. What is moving the metals? Up obviously on an uptrend, but then that big smash, and now again an uptrend.
Right. Well, as everybody that follows the precious metals markets knows, they're prone to these huge sell-offs, and many people have assembled evidence that this is, intervention from authorities who don't want that signal to go out to the public. That the signal being gold and silver soaring, that would be viewed as a signal that things are not right with the world, and you better start selling your stocks and bonds and get into precious metals or equivalent safe havens, right? So that's one element in there. The only non-intervention element I can think of is that people get panicky and they want to sell everything, and they just want to be in cash. And we might see that going forward, that all asset classes may get these massive sell-offs as people panic and just want to liquidate and just get in cash because they no longer trust anything.
I understand, Charles, and obviously we've seen many over the years, many instances where these situations have occurred. And if you remember, in 2008, these metals sold off real big, right towards the end of the panic. They really sold off. Silver went from 21 ounces, $21 an ounce to around $9 an ounce when Lehman went down. So this could also signal that we're headed to sort of a reflation era, sort of like 2010, 2011. And with that in mind, the 10-year Treasury bond now yields about 1.06%, the lowest of all times. The Fed just cut rates by 50 basis points on an emergency meeting, unscheduled. This is the asset class that the rest of the asset universe is based on, the 10-year bond. So what does that mean going forward for real estate and for the stock market?
Well, that's a big question, and again, I want to stipulate that I don't claim any expertise in all the complexities of the global bond market. I'm just looking at it as a layperson, as the largest asset class in the financial world, right? I mean, real estate is also, I think on the order of about $100 trillion market globally. But in terms of like so-called liquid assets, financial assets, then the bond market is the 800-pound gorilla. So we want to focus on that, because what happens to bonds, of course, influences all the other asset classes just from its size, and the fact that institutional players tend to be big players in the bond market because they need to tie up some sort of reliable income source, right? Like insurance companies and that kind of institutional buyers. So for the Fed to cut rates, obviously a move of, if not panic, then of desperation. And around the world, we've seen a move over the last few years in Japan and Europe to negative rates, right? Where it's actually costing you money to park your money in a bond. That until the coronavirus COVID-19 hit, that trend was reversing. That the move to negative interest rates was not accomplishing what central banks were hoping for, which was rapid growth and so on. So it was actually hurting the banking sector and creating another source of fragility. Instead of helping things, it's actually hurting things. And so there was kind of a reduction of that move. So now with the Fed lowering interest rates, we're getting back to a point where there's not much yield available globally at all. And so that creates this interesting sort of feedback, which is, if you're a global money manager and you want some sort of yield, well, then you're still you're going to be drawn to the U.S. dollar based bonds, because they're still providing a positive yield, and so you can say, well, gosh, if I buy a 30-year Treasury bond, I'm still getting 1.6 or 1.5, whatever it is, percent, and that's better than negative. So we may see this in terms of safe havens. We may see a flow, a permanent large flow into precious metals. We might see that same kind of flow into dollar-denominated bonds, simply because they're still paying a positive yield.
Okay, so and Donald Trump has tweeted on this and is very adamant that he wants to be more competitive, he calls it, and actually lower rates. You're talking about this from the other perspective, which is maybe that the competitive advantage is having a higher rate than other countries, so that business keeps coming here, money keeps flowing here. I want to ask you, from your analysis, from your standpoint, is this virus and the market sell-off going to impact negatively on Trump's re-election campaign? Do you think this is tilting the odds towards a Democratic win?
Well, that's a very dangerous question. Because, but it's an interesting one, because it's very early. But I think other commentators are already speculating that if the market sell-off really gathers a momentum, and we get a recession where unemployment spikes, as say people that work in restaurants and cafes and music concert venues, that kind of place, they lose their jobs because people stop going out. You get a huge spike in unemployment. You get a spike in small business failures. That kind of real world decline, which could result from a global pandemic, that would obviously impact any elected officials, re-election because the cliche is people, vote their pocketbook. And so if there was a very severe deep recession that say started in the second half, like say early June, it became visible and accelerated, then I think regardless of what our personal opinions about President Trump might be, any president or prime minister up for reelection while the economy seems to be unraveling, obviously he or she will be at risk of people deciding that the alternative candidate who they would never have voted for, if times were so good, well, now they're going to give that person a second look. And so a lot of people have written off the idea that Bernie Sanders could beat Trump because Bernie is categorized as a socialist and Americans don't like socialism and so on. But depending on people's economic kind of perspective as the election nears, if there's a very severe recession going on, people might look more favorably on Bernie Sanders' kind of socialist agenda as a better alternative to Trump's sort of laissez-faire capitalism.
Interesting, and obviously this is hot. This is coming in like 6 months. So coronavirus will be with us until the summer, for sure, with what's happening right now in the U.S. and how the authorities are reacting. As we're doing this interview, Washington's governor has asked people to stay home. So this is becoming a real problem. Do you assess the risk of a recession in China to be almost a guarantee in 2020?
I would say that is highly likely. And I want to explain why that, the sort of like first order effects of the COVID-19 pandemic. And those are like the direct effects. In other words, China quarantines hundreds of millions of people, the supply chain's disrupted. And it's going to obviously be a challenge to get people back to work because that sort of depends on them feeling safe enough at their workplace, right? And so if China tries to force everyone to go back to work before they feel safe, then significant percentages of people will decide not to go to work. Or they'll go to work and then there'll be an outbreak in their factory. And so it's a dilemma that many people have noticed, that authorities want to kind of return the economy to a normal state as soon as possible. But if they try to rush that, then they're basically just encouraging the virus to spread anew. So I'd say it's guaranteed that China is going to suffer a tremendous drop in GDP. And beyond that, though, there's second order effects, which are these consequences have consequences themselves. And I think what few people the people that don't follow China very closely, they may not understand that much of China's boom over the last decade was not from advances in production, although there were some advances in production. A lot of it was speculative fervor, in other words, a very high expansion of a rate of expanding debt and leverage. And so the number that's been bandied about is $40 trillion of debt in China. That's about double their GDP. That's a very large amount of debt. And there's a lot of leverage built into the Chinese financial system, both officially and in the informal so-called shadow banking system, which is loans between individuals and groups and of investors and that kind of thing. So if people have lost confidence and they're not sure anymore that the government can restart the economy and that everything is going to be restored to pre-pandemic confidence levels, well, people aren't going to borrow and they're not going to gamble and take on extra leverage. So that process will really hurt the Chinese economy, and in fact, every economy that's been based on sort of speculative borrowing and leverage.
Okay. That's obviously important as being that it's the second largest economy in the world with about 19% of the economic activity. Obviously, going to reflect on other countries, especially their European trading partners. Will the response from central banks, from authorities, cutting rates, easing, will all that just keep on fueling asset bubbles? Is that the only repercussion? Where will either inflation come in, debt deflation problems come in? Where are the big problems that can occur from what we've done in the past 10 years? Or is this it?
Well, that's a terrific topic, and I think what I would sort of characterize what you just described is we all those of us that follow the financial markets have long felt that there's a disconnect between the real world economy, small business, and people buying homes and so on, and these financial bubbles where the stock market's risen 60% in a few years while operating profits at corporate America companies have been flat. So there's been this sort of disconnect between economic fundamentals and stock valuations for sure. So as you say, where are the big impacts? And you can say, well, central banks are going to cut rates and they're going to increase liquidity and these kinds of policies that they've pursued for the last 10 years with great success in terms of raising asset prices. But is that the problem? And so the problem is not that assets are not high enough. The problem is that the pandemic is going to impact real world businesses. And so lowering rates and making it easier to borrow money is not going to solve the problem if small businesses are running out of money and the last thing they want to do is go borrow more money, even if it's at near zero interest rates, right? And then that's also going to impact banks and the financial system because if banks can't make money, then they really shouldn't be loaning money because then they're just, if they're not making money, then the risk of default increases. And then if defaults start dominoing, then you get a financial crisis because banks don't have the capital to withstand enormous losses as marginal borrowers default. So I think we also can, you mentioned inflation and deflation. I think many of us have been expecting there to be some sort of real world inflation as a result of vast money printing by central banks. And of course, many of us do see this inflation. It's just been understated. One term that I've used that's not mine, but I've borrowed it is shrinkflation, that you see this in packaging, like a cold cereal package has dropped, like 30% in terms of its weight. And I just was looking at the boxes in the supermarket, and the boxes are now so narrow that they almost tip over because, used to hold 500 grams. Now it's 450 grams. So they're hiding the fact that you're getting less for your money, quality and quantity. And of course, we've seen the service sector inflation running wild in terms of childcare, higher education, these kinds of expenses. So, but if inflation does in fact start firing up because the supply chain's broken, then it's going to have a tremendous impact on the real world economy, right? Because the purchasing power of people's earnings will be declining at the same time as their earnings may be declining because of the impact of the pandemic. And so then you've got a kind of a double whammy there. And I think referring back to the supply chain, if the supply chain has to move out of China or some percentage of it does, all of these movements are very costly, right? I mean, moving factories, setting up new factories, this kind of thing is very capital intensive. And so it seems highly likely that whatever happens to the supply chain, costs will go up. and there could be shortages, and that's in effect a way of saying that costs are going up, because you if you can't buy the cheapest product, you're going to have to buy the more expensive product, whatever's available.
Absolutely. Like you said, it was the global supply chain has been so efficient at getting products around the world, and just touching any part of it is like disrupting an ecosystem. Um, Charles, what makes you excited about artificial intelligence, blockchain, space technology, some of these cutting edge technologies that we see? What fascinates you about them? Where do you see them coming into our lives?
Yeah, it's a great topic. I'm glad you brought that up. I guess I'd start by saying the typical commentator in the mainstream media, it looks at AI and related technologies, automation, as boosting corporate profits. Like it's all about, well, we're getting corporations can get rid of people and employees, and therefore they'll make more money, and that's going to be good for asset prices. And so, for example, Amazon has been testing employee less, these little markets without employees, right? I mean, obviously employees come in at some point and restock, but basically there's no checkout employees. You enter the store with a smartphone, and you buy what you're going to buy, and then when you exit, it's all billed out to your smartphone accounts. I think that's kind of missing the point here. I think the larger point is, how can we improve productivity around the world, because that's the only real source of wealth creation, right? Is to improve productivity. And so I think the big impact will be improving the productivity of people around the world, not getting rid of people as employees, right? It's more like boosting the productivity of people, and that's what's exciting to me.
100%. Your website is full of great stuff. You published many great books. Where can people check them out?
Yeah, come to my site of2minds.com, and you can read the first couple chapters for free and see if you're interested in buying the rest of the book. And all my archives are free as well.
Charles, of2minds.com. Thank you very much for joining us.
Thank you. Thank you for the great questions and topics.
Andrew, thank you very much.
Thank you.